Good morning. We are Mortgage Pros 411. I am Audrey Boissonou with my co-host Kevin Casey. And today we are joined by the wonderful Tracey King, who is the COO of Partners Credit. Welcome, Tracey.
Thank you.
Okay. Occasionally something catches my eye that might be not necessarily mortgage related, although I don't know how I would run my mortgage business without the ability to occasionally vent. So with that, occasionally I will send a text and my phone will inadvertently change a word to ducking. Has that ever happened to you?
All the time.
Okay. So I was so happy to see this headline today. The iPhone's ducking autocorrect problem finally gets fixed. That's right, folks. They are going to take care of that little anomaly that should never have happened in the first place. You know what else it's going to do? Another pet peeve of mine. It's going to know when to change your to your, Y-O-U-R to Y-O-U''R-E.
Yes.
Oh, that drive you nuts? That drives me nuts. Anyway, and just for those who are curious like I am, ducking is actually a word. It's a noun. And it means the act or period of going below the surface of the water. So the boat turned over and we all got a ducking, which we could use that a few different ways. But anyway,
wait. But what are you trying to write when you wite ducking?
Don't even go there. Don't even start with me, Mr. Casey. Do not start with me today.
Come on,
Kevin. Anyway, that's some good news. We're going to start off today with some good news. Bonds are not getting hammered for once, knock on wood. So that's also good news. And why on earth are we having somebody come back so soon to talk about credit? Why would we do that? Because it's so confusing. All these changes are so confusing. So we're going to take a dive into that today and try and clear up some of the questions that we had from our last go around and see how we end up there. So really, Tracey, the more I have taken a dive into this, the more I've realized there's still a lot up in the air, but there are some things that we do know, right? So
kind of, yes. I'm going to make it as clear as mud for everybody today.
Appreciate that.
But hopefully we'll put it in a way that makes it a little bit more digestible, gets you an idea of where things are headed, but know that you are not alone with a big question mark over your head of everything around it. That's where everyone is. So you're in good company, but we're going to navigate this together. Yes.
That's beautiful. Okay. So the one thing we do know is that the GSEs are fixated on changing the credit score models. Can we agree on that?
We can agree.
Okay. So that's great. Now, have FHA and VA gotten on board with this whole idea?
We do not know that.
Okay, just checking.
Or is that a secret?
No, it's not a secret. They're just not, they haven't chimed in yet. So we don't really know what's going to happen when
so what you're saying is the Fannie and Freddie will switch over to Vantage, but FHA and VA will take another 10, 15, 20 years before they come around to it.
I don't think they'll have a choice of accepting the new scoring models. I think what is going to be a question mark is what I haven't heard yet is if they are going to accept a buy merge. So I think that there's the difference between score models and actual how many scores you're using. So that's something I know we're going to get into a little bit, but I think that will be the difference. And that's the first phase of this change that's coming.
So let's talk about this timeline just for a minute so we know what we're working with. And again, why are we talking about this when there's so much uncertainty? Why does it matter? Why don't we just ignore it till we get to the end? Well, the proposed rollout right now begins in, when is it, Tracey?
Q1.
Q1 of what?
24.
Oh my God, when is that?
6 months away.
6 months away.
Oh, I know, 6 months and 20 something days. Yes.
Yeah, whatever. Anyway, we're not going to count because we're going to be all getting ready for Festivus, so we will be busy in December. So anyway, this first initial rollout is proposed for 6 months from now. It is very important to note that every time that I've listened to anything, and Tracey has been really helpful with this too, is they are very clear that they may push or change the timelines. Yes.
Yes, everything is proposed. Everything is tentative. That is, they keep anytime they're saying anything that they keep repeating that. But maybe the most important thing to kind of highlight and to go into this is what they're calling this time of their whole plan is the time of feedback. And so that is what I think we want to bring to your audience and make sure everyone is aware of right now. When you're having these big question marks, it's not something just to keep contained within your company or between your circles. It's time to start having your voice be heard. The GSEs are doing surveys that are available to everybody, and I think we can share links for that. But it's extremely important to ask these questions that you have, and hopefully we can get you to a place where you feel more confident asking these questions after some of the things that we talked about today.
Okay, so and the other thing too is, I mean, like our borrowers need to be prepared for this. So again, back to a few weeks ago when people indicated that they had quite a vivid feeling for some of their utility companies, the idea that maybe those payment histories might be reflected on a credit report sometime soon. We need to let people know, right?
Right. So there's already, there's already been a few things implemented by different bureaus. How much CRAs have implemented them yet?
Okay, hang on, CRA.
Credit reporting agency like myself, which is confusing because the bureaus are also referred to as CRAs.
Reporting agencies, okay.
Yes. So our official title, you could call us a reseller or a credit reporting agency, but the bureaus, so Equifax came out with something. So someone brought up Boost. So Experian had a product named Boost, in which basically would be able to provide these ancillary, utility bills, things like that. Equifax also came out with something recently in which it could be an addendum to the credit report where a borrower would have to opt in, or I believe down the line it'll be opt out to have this additional information included on their credit report. But at the end of the day, it does not impact the score. So it's data that appears, but it is not a part of the score. I believe what Tony was talking about, and Tony was, for listeners now, was the previous guest that was speaking from Vantage Score, which is going to be a new score model introduced down the line. He was saying that they were going to try to incorporate rent history, utilities from companies that was going to provide that information. So like, that's the big
from companies. That's the big thing, not from an individual landlord, but from a management company, company or something like that.
Right.
Okay.
Yeah. So, I mean, and the big question is, and I believe Audrey brought this up, is does everybody want that on? I think a lot of people, especially knowing that it isn't being reported to the bureaus as now, they'll be like, oh, I'll get a late fee, or wow, my PG&E bill was way out of this world this month. I didn't realize it. I'll just kind of like work my way through it, make multiple payments. It doesn't matter because it's not a 30-day late. So do you want it on there? How much is it actually going to help you? What does this indeed showcase? The adverse side of it, of what she was saying, is that you have people out there that are paying a significant amount of rent. There are low income borrowers that are making scheduled payments on time.
Mm-hmm.
And why does that not contribute to what they're doing? So, there's, for me, he also brought up, there used to be a manual underwrite. A manual underwrite still exists. There are ways to help a thin file out. It's just, we have gotten used to automated underwriting systems, and it makes it more challenging. So for where we are right now, these are big questions. I don't know. Vantage is talking about how that will be there. I haven't seen it to know, and I would be curious as to how much reporting actually happens to make an impact on a scale that they're saying.
Well, so that's one of my, the more I learned about this, the more cranky I got, because I feel like the entire mortgage industry is just struggling right now. So it was interesting when you're watching these people, and they're like, and they're literally putting poll questions, the Fannie Mae, Freddie Mac representatives putting poll questions up on the screen saying, so tell us how prepared you feel to handle this. Tell us what kind of resources you have to handle this. And I'm thinking that people have been laid off. Lenders are just scraping by. The cost per loan is going through the roof. Why don't you explain to me how this is going to ultimately benefit the borrower? So as much as this is going to cost the entire industry and then trickle down to every single consumer, because you know that gets priced into a loan eventually, how much is it going to benefit someone? Show me that this is better. I would like to see that. But in lieu of that, we got benefits. Responsibly increase access to credit. Both new credit score models consider trended data and new payment history, example of rent, utilities, and telecom payments when available, and then enhance risk management. So both new credit score models provide more precise assessments of credit risk than the current model. So can we talk about this trended data?
Yeah, that's exactly, I want to get, what is trended data and how does it affect you plus and minus on your?
It was added to our credit reports years ago, and then Tony
Years ago.
made a comment that it wasn't really part of the scoring models yet, but it was going to be. Is it? Tell us. Just tell
Yeah,
us.
so a few years ago, if you remember, like one of the last bigger increases prior to this was when they added trended data to the credit reports. Most of you don't even see that. When you're looking at your credit report, most of our customers don't have it included because your credit report would be 3 times the length. So what trended data does is it looks at, so when you're looking at a credit report, you're seeing a snapshot. You're seeing the last payment made and what the balance.
The movie.
Trended data will show you the last 12 to 24 months of what the actual payments were made. So you can have a borrower that pays off their credit card every month, but that doesn't help their score because it's a zero balance. Or you could say, okay, they're making a payment last month and to make it look really good, they did $500. But actually, they're only paying $20 per month. It starts to give a more comprehensive approach as to how the borrower is spending or paying their bills. So when trended data was added to the credit reports, it was added to the raw data. So when you're reissuing that to the AUS, that raw data is included on it. And it was very, very, kind of tight-lipped when it came out that the GSEs were saying it will have no negative impact on any borrower. The only thing it can do is help. Now, what that means, it was never given. It was, if anything is going to happen, it would have a positive influence on the outcome of the borrower.
They said the same thing about, the FICO score will help low-income borrowers also, or underserved borrowers. But when you look at the FICO or the Vantage scoring system, like all the numbers are like, they start out with very poor category, poor, fair, and you're now at 660. You're only in the goods at 661 versus, FICO starts out at, poor.
Well, right. So, I mean, that's kind of what's coming down the line too, right? So you need to think about a couple of things here. And so while we get into the changes that are coming, they're all coming in phases, but part of the last phase is going to be changing the FICO score that we currently have. And what we need to remember is that the FICO score model that we are currently using is 25 years old. In the meantime, FICO has updated their scores. It just has never been approved by FHFA. Now they've approved it. So they have a new score that FICO is going to be implementing, and that's FICO 10T. At the same time that they roll that out, Vantage score will be also added to the credit report. So we'll take a step back. Phase 1 that Audrey was talking about is Q1 of 2024. That's when they're saying we're going to move from a tri-merge of the existing FICO to a bi-merge. So that's the first start. So bi-merge would just mean 2 bureaus are needed to be pulled to submit to the GSEs. That's where you kind of come into the question of, okay, how is this going to affect your process? Because if you pull a tri-merge, you have to use a tri-merge. So it's very attractive to us because, as we know, we had a huge increase this year.
Right.
So people want to have a 2 bureau.
Yep.
A lot of you have pricing bundled into your tri-merge, like your reissues, your secondary use fees, your supplements. pricing is going to have to be restructured. So what you have as a cost of a 2-bureau now is not necessarily going to be what it is next year, because it's going to have to take into consideration all those things. But then what happens with your process if it's going to be a VA loan or FHA loan? How is that going to impact you, and what are you going to do? So, and then also if you're using a different aggregator, which means you're lending that to someone other than Fannie or Freddie. So
Aggregator, let's talk about aggregator just for a second. Just to be clear, aggregator are the companies that buy the loans to service them when you're not selling them to Fannie and Freddie, the GSEs. Yes. Okay.
correct.
Just want to make sure that, because that's not always clear to everyone. All right.
Yes.
So
Yeah,
So
that's a
have
mess.
an impact on your process. Yeah. And we haven't heard anything about that as of yet. Of
Right, and
who,
then I got another thing. What happens when like a credit report expires and now I have to run a new one? Can I at that point say, wait, FICO was a little bit low, but the TransUnion was higher. Maybe if I ran an Experian, yeah,
whatever.
yeah,
yeah,
that maybe those two would be higher score than the one that was a lower score last time. Would I be able to do that then? Or,
I think Tony said no, didn't he? He thought that
yeah.
you
So this is
able to
part of
do
the
somebody- I thought-
conversation.
yeah,
Is, so what I will say is that Fannie and Freddie have been very proactive about speaking to credit reporting agencies and lenders to get feedback and ask us for our initial questions. And that was part of ours is, I would never suggest that anyone would be gaming the system, but how they are either going to monitor if it was started as a tri-merge and then you just repulled it as a bi-merge. To pick, your
the two
favorite
best, yeah.
words, and who would be responsible for monitoring that. So is that something that they'll be able to track when it's reissued, or is that something that puts the onus on the credit reporting agency to flag and stop it? So there's a lot of technical aspects to this that may take longer to put in place. So it's great if it's a bi-merge, but if you want to put restrictions and parameters around it, you have to give organizations like myself the time to build that into our systems. And not only us, LOS systems, how you're submitting it through that, how MI companies are going to be dealing with the bi-merge, what that looks like. So
it is. And then what are we gonna do? We're gonna have like the police show up. Listen,
right.
we know that you pulled a different bureau. I mean, come on. Like,
Right.
don't we? And by the way, everyone has the freaking bureaus on there. That's ducking, not anyway, they have them on their phones. We all have the app showing what our credit scores are, sort of. So it's
Right,
not
but a lot of
like-
times,
there's
when
a
you meet our
million ways to
clients,
get around that would never have anything to do with the process. So can we just let that one go? Maybe, I don't know.
Right.
so what you're supposed to do is have your clients tell you what the credit scores are on their phone.
Everybody's, but that's going to be a thing, right? Well, I just went through Credit Karma. It said my
Yeah.
TU is this and my Equifax was this, and
Yeah.
or go through a competitor and a competitor pulls
Right.
it and
Right.
you're looking at somebody else's credit report and
That's right.
so then is it advantageous to shop around before you go and end up where you're going to be, or if they came to you when somewhere else then came back to you?
Yeah. Yeah, no, I mean, there are a million variables that people who sit in an office analyzing stuff have no clue about. That is
Right.
why, and my concern is, the GSEs are going to you guys and they're going to the bigger lenders. But first of all, I find in the industry that there is sometimes a reluctance to tell Fannie and Freddie or the GSEs or any Congress. There's a hesitance to tell the truth because they don't want to offend someone or upset them. Or if I say this, then what impact does it have on this part
You
of
don't
my
have that
business?
problem, Audrey. You just tell them.
I get in trouble all the time, Kevin, all the time. I mean, it's ridiculous. So with that being said, I feel like the more truth that is spoken, the better off we all are. And ultimately, if we could, I don't know, keep the consumer in mind when we're doing all this, that'd be great, because that certainly doesn't seem like it is the motivation for any of these entities that are creating all these systems. So my point after all that is, it is important that the individual LOs, the individual brokers, that we are part of the conversation, because we are dealing with the clients one-on-one. We know what the real world problems are. We know what the cost impact is to the borrower and on our businesses. It's a big deal when they make these changes. And so they don't hear from us enough, I don't think.
Yeah.
And so that is why
That's how we ended up with a new 1003 that doesn't have housing expenses on it.
yeah, right. That is the dumbest thing ever. And by the way, that's really on all of us, because
It is on all of us. How did we all miss that?
We're there on that
It's
thing.
missing.
We still missed it. It was so, we're like, yeah. I'm sure someone else will notice, right? No, we have to be the big mouths, and we need everyone to be participating.
But you have to do it in a way, you don't just come up and say, you're a ducking idiot. You have to say.
Right. Well, listen,
Exactly.
apparently moving
I
forward, you won't
don't
be
do
able to,
that.
yeah, you won't be able to hide behind the ducking anymore, but
Exactly.
but to the cost standpoint, you know, and I can share, they've had forums where they've gone through these timelines, but a really big piece of this is after the phase one of the buy merge, the next phase would be to introduce the FICO 10T and Vantage alongside the existing FICO. So what that means is that right now, well, not right now, the second stage of the phase would be for an individual borrower. If they were on a buy merge, they would have then 6 scores.
I'm sure that'll be cheaper. Like, I mean, what could go wrong with that idea?
Well,
Right.
I don't get why they want to make all these changes. Why don't they just pick one?
Because they're all operating as set. So the one thing that could, you know, is a little gray is, you know, the existing FICO and the new FICO. You would think that they had a side by side internally to know what that looks like, where you could just phase into this. But essentially what it turns into is that we are all part of a giant pilot program, where that's where they're going to get their comparative data. That's where they're going to see how everything is used. So I believe during this time, you will have the new FICO and Vantage, but you're not submitting that information or making a decision on that loan based on that information. This is just when they're collecting data, see how it works. But that again, it has to be up to us to be able to collect and submit all of that information, having all of that information be able to fit into Encompass or Byte or your POS system, or, you know, all of this. So it requires huge lifting and confusion. And to Audrey's point, it's going to have your borrower sitting there. And if it's a husband and wife potentially looking at 12 different scores, and what does this mean for me? So when we had our call with the GSEs about this and they were presenting, they said, do you have any questions? And my first question was, who's paying for this?
Yeah.
How do you expect our lenders today who are struggling, as you said?
Yes.
Credit report and your LOS are probably your most expensive invoices right now. So now you're wanting to increase that even more, even though it was under the guise of, you know, we're going to have competitive scoring models and it'll make it cheaper and we'll only need 2 bureaus. Well, yeah, maybe in like 3 or 4 years, but up until then, who's paying for this pilot program?
I suggested to Uncle Tony that that they should let us have this for free when he proposed that we should all start working with this now. And I'm like, how do you expect us to do that when it's going to cost more money? So,
well, and yeah, and also it's not approved. So
right.
Vantage has been around for years and years.
Yeah,
It's
clients
just
been
not
calling
the
us, telling us
GSE.
clients been calling us, telling us they're great Vantage scores. I'm like, that's a Vantage score. It's going to be blown away when I pull your real credit, and you're going to be, you know, low 7s, not 870, you know, but
It's 970. They're all 970.
970s. Yeah. Actually, and it's really funny because according to this, the Vantage scoring guideline only goes to 850. And I'm like, no, I've been hearing people telling me they got scores on 900s. So.
Okay, so we have a comment from somebody who says, shouldn't LOs work through their company or state local organizations to tell the agencies? Also, both Fannie and Freddie are accepting public comments on about current trends. And my answer is no. My whole point about the companies is my company, God bless them. I mean, they have to put up with what comes out of my mouth, and I'm not exactly quiet about it. So they manage that somehow. I'm not really clear on that, but I appreciate it. But they, like companies have to deal with the GSEs and sell loans into them and deal with the audit process and do all sorts of things. And they have to play nice. We need to tell them the truth. We're LOs. Like, how does this really impact us? And then the companies, of course, they're going to understand the logistical part. How does it all fit together with the LOSs, et cetera, et cetera. I mean, which is enormous, but we can speak to how does this impact the process? How does it impact the consumer better than anyone else?
Yeah.
We can, the LOs can. So they need to hear from us. And so Tracey, if you can share whatever links you see, and then we're going to forward those on to people and let people know how they can comment too. I think it's really important. The other part that I thought was really interesting is because, like right now we know how we choose which score we're going to work with, right? We have 3 scores. You take the middle one.
Yep.
You have 2 borrowers. You take the lowest of the 2 middles, right? Okay. Listening to the woman describe it in that thing, I was dying. And the second time I listened to it, I put it on double speed because I couldn't sit through the whole thing twice, like without it. But then it sounded like a chipmunk explaining it. But basically, it sounds like they're going to do more of an average, right? Then that you're not going to take one score over the other, but it was like you're going to
average of the 3.
I don't know. Tracey, do you know about that?
Yeah, so do you want me to share my screen for this?
Yep, that'd be
I
great.
would love for you to. I'm sure everyone else would too.
Wait, let me take down all the, things I was looking at before this. So,
Yeah.
okay, let's see if this
Yeah, we
works.
don't want Audrey's credit score popping up there.
Right.
At least I paid my, yeah, never mind.
Okay,
Somebody
so
made the comment, it sounds like more money going to big tech as a tax on every consumer. Right. So
Yes, I would agree.
it is. Well, remember, Vantage is owned by the bureaus. FICO is a separate entity. I mean, it kind of, the writing's on the wall a little bit of why FICO probably increased their fees so significantly at the end of last year. Yeah. Okay, so what I'm sharing is nothing secretive. Everyone has access to this, and I want to make sure that this is based on a forum that I attended via the GSEs, and you can watch this yourself. I can share the link with Audrey again for everyone to go and look at. So the first thing, so you're looking at sorry for my version of this, but when we were talking about the timelines, this is the timeline that they provided to everybody. So again, this is their industry feedback kickoff time. The buy merge starting in Q1 of 2024, where it's requiring it, again, tentatively. But then the big thing again is third quarter, when we're going to have the 3 different score models, and then incorporating those score models not till Q4 of 2025. So that's their proposed timeline for now. And to answer the question someone asked earlier, what's that score calculation? How is it done? Again, if you listen to their webinar, everything is proposed. So they have not made a decision based upon this. And they're giving several different options. And I know this is probably really small. And if
it's okay with you, what I could do is I can give this to Jason Bellevue, who does our YouTube page or channel, and he could embed this within the recording on YouTube somehow. Can we share it with people that way? Is that all right?
Sure. Again, it's open to you. You can go look at the same information. They have this published. These are just my screenshots from, it was a May 17th webinar. So this is a couple weeks ago, but this is what they presented then. And I'm sorry, I have a cold.
No
Right.
demo.
Glad
So-
to with us.
Yeah, so if you can see, and if I was a good person, I'd know how to increase my screen size.
Plus, trust me, we're not judging anyone based on any of
Yeah,
that.
no.
But essentially, even here, they're showing different potential scenarios of how they would look at the different borrowers, the different scores. And so they do talk about having a median lower of the two or an average and what that would look like between all three.
Yeah.
So it's a little bit different than how we do it today. But again, they're saying it's not any final decision. It's why your feedback is crucial to this, is kind of looking at this. What's the difference? What are the situations and to where this is not a benefit for the borrower or could be a benefit for the borrower? It's that loophole, right? That we want to make sure everything is for the borrower, the best possible outcome for the borrower.
Right. I mean, what do you guys think? Let us know, because I know what I think. Tell me
Yeah,
what you
no.
think. Yeah, we totally want to hear that.
I think there's less complicated ways of doing this, but that's just me.
But that's not the government way. Come on. Right?
And this, speaking of we have only a few more minutes left in the show here. We kind of spent the whole time on the new credit scores, but there's lots of other stuff going on in the.
I thought that was the whole point, Kevin. But yes, he's right. There are a few other things to mention. It sounds like Kevin might have something he'd like to share. Kevin, go right ahead.
Yeah, actually, my personal one is I had a little run-in with opt-out pre-screen this last week.
Ooh,
Yeah,
a
so
run-in?
yeah, so my first comment, let me fix my, sorry, I'll leave it as it is. So I have been diligent about making sure all my clients do the opt-out pre-screen so that they don't get the million phone calls when credits are pulled. And my company is one of the companies that's experimenting with the soft pull credit reports.
Yes.
How many companies have that program, do you know?
I don't know, because we weren't even allowed to talk about it, which I
Right.
think I did probably on your show.
I'm probably not even supposed to say it either, but
Yeah, I know, I believe they've closed the pilot.
well,
But I do not know.
we love it. It's just like everyone I heard back from, like, oh my God, this is great. I can pull credit. So several reasons why soft pull credit score, because so we can pull a soft pull, doesn't cost as much. No inquiries, or the clients aren't enraged with the disclosures of all these people now calling them saying, oh, your credit was pulled. And then it saves the company money because a soft pull is cheaper than a full on credit report. And in this world where we're having, I heard some statistic that only 1 out of 100 loan applications are closing right now. That, there's that huge cost that you're not having to deal with anymore. The problem I had was when I closed a loan last week, even though the client had opted out when the final lender pulled their final credit report, my client got deluged with 80 plus calls into their cell phone within minutes. And they just said, what the heck is going on? Now the great thing was the loan was closed at that point, so it wasn't a problem from my side, but it was definitely a problem for the customer. Now the only
Important
thing
to note that Kevin's loan was a private money loan, lest you be wondering how the hell he closed a loan without pulling a real credit report.
pulling a real credit all the way to the end. That was the sweet part. Now, the thing though is my biggest gripe with opt-out pre-screen is it defaults to opting in, which is, why would you call a company opt-out pre-screen if the default is to opt in?
Oh, so they didn't actually opt out. They thought they did, but they opted in.
So that's my only thing is I think they must have missed the right, because what happens is you open up the screen, opt out, you go a couple screens, and then it says, do you want to opt in, opt out for 5 years on electronically only, or opt out permanently by mail? And then, so really your only real option are the first two, because the other one, you have to do a whole bunch of more steps, and it's much longer. No one wants to do that. So what everyone wants is the opt-out pre-screen by email or electronically. But you have to remember to move the marker down. Otherwise, you're actually literally opting in. And I've had a couple clients that I've sat there and walked them through it. Like, no, you're opting in. Like,
oh,
So
Yeah,
maybe an IQ test before.
so just to put it out there for loan officers,
Website would be in
make
order.
sure that the clients understand the default option is to opt in. They have to make sure they change that option to opt out.
All right, that is excellent, excellent advice. We have a few comments. First of all, Lilia said she thinks that FHA, VA, Freddie, and Fannie should all come to an agreement on what the scores, how it's all going to be used before we do anything, which I couldn't agree more.
Well, just to put that thing there, because I did this morning. I pulled up, I went to Washington Examiner, had an article of differences between FICO and Advantage. And then I was looking at the differences and I said, wait a minute, but Fannie doesn't follow those guidelines. So I pulled up, I literally went to one of my loans and I priced it at every price range. So for Fannie, anything under 620 was bad. You can't even do the loan. Okay, this is on the one loan I picked up. And then, and this was a simple cash out refinance, really low on loan to value. So I just kind of kept it really simple. But 620 couldn't do the loan. 620 to 659 had the biggest hit. 660 to 675, a little less of a hit, and then 680, 699, not so bad. And then after that, it was 720, 739, a little bit of a hit, and then no hit after 740. So their ranges are completely different than, because if you compare what FICO says their credit scores are, FICO says a very good credit score is 740 and above. Well, Fannie is considering that an excellent score.
But they're still just providing what it is for FICO right now. I think there's going to be this comparative. I think that's part of the pilot, is that they're going to be then reviewing all the data from each of the different scoring models to see what that scale would be for each. It's because the 660 for Vantage is not the same for FICO.
No, I agree, but I'm just saying that right now that they're not even matching up with, what's really good by Fannie compared to what's really good with Freddie. They don't really, with FICO. They don't really match up now. They're just they're both kind of here and slightly off. So it'll be interesting how they finally come to a realization of it. I think they should just, run all three and then trend it out and figure out, okay, Vantage is this way, and this one is a FICO score. And we're noticing that particular borrower had a 744 Advantage and a 633 FICO might be the exact same person. And they just figured it out from there.
Oh my God, my head's going to explode.
Yeah, I know. Way too many numbers. We got to get away.
Oh my God, geez Louise, can we move on? I mean, all the scenarios, I'm like, good God, I don't know if anyone else is experiencing this phenomena, but you can only take this in little bits, right? Otherwise you're like, ah. Somebody said, if Fannie and Freddie want to pick up the cost of having 6 scores per borrower instead of 3, then let's do it. Otherwise, they need to understand this will just raise costs to consumers when their goal should be to reduce costs, which don't even get me started. There is this thing I learned about last night called, hang on, let me see. It's LIP and VLIP. I had to pause right there. It is, and apparently everyone has these conversations with a straight face. So anyway, so it stands for low income programs and very low income programs. And it is going to be something that we're going to be hearing more about because Fannie and Freddie are very focused on all of this, and it's impacting how they're pricing our loans, which I don't know much right now. I'm learning, but I don't even know what I'm going to need to do. I just want to point out, we have really sweet listeners. So Trent had said he had given you some coaching on how you could have gotten the size of your screenshot bigger, which I thought was sweet.
No, I saw. Sorry, Trent.
I know. It's way over our I couldn't even begin to fathom how to do that in the middle of all this. Steve's asking if this PPP will be sent in. Again, we'll just put it in the YouTube. We'll put it on the YouTube channel.
I think it's best for everyone. We'll have a link for the forum that they did, in which they have all these shots for you to grab and see.
Yeah. Very good. Okay. So there are a few other things. So somebody made the comment that trigger leads, when are they going the way? We hate them. They were very adamant. And we agree completely. And that is a bill that is in Congress right now. So make sure that you are letting your, if you know any Republican Congress people, that they need a co-sponsor. And it sounds like it's in the works, but we'll see. I also thought this was very interesting. So there is a bill titled the Middle Class Borrower Protection Act of 2023. And it was introduced by Representative Warren Davidson. He's a Democrat out of Ohio, that would cancel the changes being made by to the single family pricing framework by FHFA. So the updates to the framework and its impact on the guarantee fees of federally insured mortgages have sparked in-depth debate on the subject, as we all know. And so that's something to watch too, because it'd be interesting to see if you could get Congress to squash FHFA's LLPA adjustments, because I don't know what else is going to do it, because I don't see them moving.
Believe it or not, Audrey, you spoke directly to Senator Thompson in public at a public forum, and I believe ducking was mentioned.
She probably wanted to duck while I was speaking. I was very well behaved. I just want to state that for the record. I was on my very best behavior, and actually think I forgot to breathe in the middle of it. So yeah, it was kind of an interesting situation, but I did try to make our case, people, directly to her. So with that being said, there is a rumor going around amongst the realtors that the LLPAs have been squashed, and they're confusing it with the DTI requirement or the DTI hit going away. And so
I think there's some LOs that are confused also.
Well, that is true, but some of the LOs have heard it from realtors, but I've heard it from multiple sources that this is being, and from one end of the country to the other. So this is a problem. So if you are an LO and you are listening to this, this is something you can talk to your realtors about. Make sure they understand that the LLPAs stood and are still there, and that the hit for DTI over 40 is what went away, nothing else. So we still need to be focused on the LLPAs being redonkulous. Okay, this is funny to me, because I thought it ended like 16 times, and the last time I thought it was like 6 years ago. Okay, that's a little hyperbole, a little bit. But LIBOR ends next month. Kevin, did you think LIBOR still existed? I mean, I thought it was over, but it's not. So anyway, if you have clients who have LIBOR as their index, they are, and it hasn't been switched to something else yet, it will be by next month, apparently. So there you go.
That's it. That's interesting, just because I'm curious how the banks that were using that on existing loans are gonna.
Well, they have to pick an index, and they have to have like thought about it before now, for God's sake, right? Okay,
Yeah.
So how about this one? So we have, the rate situation that's been ongoing, where the rates went up and up and up, and potentially buyers didn't want to buy, whatever. So it says most potential home buyers are waiting for rates to fall. So the question
By
of the
how
day is,
much?
how much do they think they're going to fall exactly, and when, and if, and. So again, conversations for us to be having with our clients, with our partners that we do referrals with, et cetera, because what we're also seeing is that CoreLogic came out with their home price appreciation today. It was up 1.2% month over month. It's up 2% year over year. Black Knight came out with theirs, and these are for the month of April. They always lag a little bit.
Yeah, but they're all going up. I've noticed.
0.5% in April. It is, home prices have gone up for 135 consecutive months.
I thought it went down for a little bit. No,
Yeah,
maybe that's
right.
Yeah.
But what they do is they look at the aggregate, and so then they were like, well, it's the last 6 months, it's only been single digit appreciation, and I'm like, that's good. Nobody in their
not my neighborhood.
wants double digit appreciation, do we? No, and no. So the bottom line is the forecast for appreciation is nothing but up from, and inventory has declined in 95% of the markets that they look at. 95%.
There's nothing out there.
There's
That's the
nothing out
number
there.
one issue right now. Can you imagine if all these people start coming into the market? There'll be 50 offers on every house.
But the
I know.
other thing,
Rob, our buddy Rob put something in his commentary the other day of the amount of houses that were out right now. And
Yeah.
it was shocking. It was shocking.
Yeah, no, it's scary. I've got several clients. That's my biggest problem right now, is coaching clients through, okay, there's nothing out there. You're going to have to be really aggressive and just, settle for something you may not normally wanted to settle for. But if you're not willing to do that, I don't know if I don't say this thing out loud, but I'm thinking of in myself. I
Yeah,
don't know
you
if
should
the court
definitely
would
say it
find-
now. It's only gonna be on YouTube. Go right
Oh,
ahead.
on YouTube.
What were you gonna
I
say?
think that's the last thing a home buyer wants to hear is settle. It's a hard pill to swallow, right?
It is a hard pill, but if they're not, I don't want to, I'm kind of thinking this out. Like, I was going through all my deals. I'm like, how do I get these people to either not go through the process because they waste everybody's time because they take the loan application, they get approved, they make the first offer, and there's 15 other offers, and then we don't want to do this. We're going to wait for rates to go down. How do you think it's going to be better when rates go down? There'll be 50 offers, not 15.
Yep.
And it's really hard to coach the clients on how to get over that hump, because there's that resistance of, I don't want to do all that work. And it really hurts when we fell in love with that house. And,
Well,
now.
Kevin, a question for you on the other side of it is that, rather than, I get what you're saying, devil's advocate, but would it also be that if rates did go down, people would be more likely to not just buy, but sell and buy? So a lot of people are scared to sell because there's nothing out there for them to buy. But if rates go down, maybe that'll increase the inventory a little bit.
That makes sense. There's several other things actually that are starting to ideally help inventory. And Audrey and I were talking about this last week, but Airbnb has taken a lot of homes off the market, and they have done something with their algorithm where there's so many more people putting homes on Airbnb that people that do Airbnb are like, hey, wait a minute, my place is no longer renting anymore.
Yeah, they're not making money.
Or I have to rent it out for nothing, basically.
Oh, because there's so much competition.
So much competition. And so people are starting to realize I'd be better off just finding someone to rent my Airbnb as a place to live instead of having to do all this work for Airbnb and all this other stuff. I'd make more money on just renting it out. And that math is starting to play into the game. And that would actually open up some housing, I hope.
Or sell. They're selling.
Yeah, except they sell it. Yeah, that'd be awesome.
To Tom's comment, rumor has it that if you remove phone numbers from before pulling credit, it prevents all the calls, although it doesn't help if your borrowers automatically pull credit when the numbers are in there. And the answer is no. That helps not even a little bit anymore. And my suggestion, do you remember this? I suggested we put the consumer complaint line for the CFPB in.
Oh yeah,
my phone number. That was my.
That doesn't work either.
I don't think that
no,
works.
because
I
none
put
of
my
that
own phone number
data.
one time. That didn't work either.
Yeah, we don't even submit that data to the bureaus when we're requesting credit. That's
Right,
not.
because they just see that Tracey King's credit was pulled. Oh, what's Tracey King's phone number? They pull it up off a database, they call it, and done.
They have everything. They have all your,
everything.
we don't give them your previous, all that information. They have it when you apply for a credit card, when you apply for a loan, they're collecting all that data from you and have your phone number associated with it, all that.
That's right. So Foster says he just got a letter from a client provided by his lender Chase recasting his 7-1 ARM to a new payment beginning August 23rd. The new payment was based on LIBOR. So not sure exactly how this is ending. So keep us posted on that. I'll be very interested to hear about it. I mean, come on, Chase is sending out a notice right now. Okay, so somebody pointed out that within the industry and all the layoffs, all the many layoffs, that the industry is mostly laying off women, which I hadn't given even the slightest thought about, right? But if you think about it, okay, if you're laying off a bunch of underwriters and doctors, and if that is predominantly women who are doing those jobs, then that's not great overall. All right, another little situation. So I have this little client, very sweet woman, who lives in a condo and it has an HOA. And a few weeks ago, their neighbor was barbecuing on the balcony and caught their unit on fire, which then spread to my client's unit. Why are you laughing, Kevin? This is not funny. Okay, so they were able to get out with their lives, Kevin. I'm glad that you're so amused. But it really took out their units, right? Okay, so you think, great, everyone contacts their insurance agents and they all work it out and it's gonna all end happily. The problem is not everyone had an insurance agent. That's before we even get to State Farm and Allstate pulling out of California writing policies. So what happened at that point is the condo association has insurance and that will cover the exterior of the building, but the renter didn't have insurance, nor did the landlord of that renter. They're the ones who started the fire. And now my client, who did have insurance, thank God, on top of her HOA. Why did she have insurance, you ask? Oh, that's because when I closed her loan, it was required. Remember the HO6 insurance that we all think is a bunch of bupkis and we don't want to deal with it? Nope, actually, very good thing, as it turns out. So
How did the landlord not have insurance? Like, how is
Well,
that?
mortgage.
because they had no mortgage. So guess who is
Brilliant.
going to probably eventually get sued, and they'll eventually have a mortgage, or my client will own their unit. I don't know which one will happen. It's anyway, my point is, do not undersell the importance of having insurance coverage on your condo, even if you own it free and clear.
And the other thing too is watch out right now, especially in California, insurance companies are canceling insurance for 1 day late.
Yep.
So I experienced this with a rental property I
Talked
owned.
about this last week.
Yeah, this happened last week. I talked about it this week. Yeah, but it was like, it's critical. I got lucky that the new insurance policy turned out to be $400 a year cheaper. So I was like, oh, okay, it was a good problem to have. But the likelihood of that happening is slim, especially with, Allstate and is it Fireman's Fund both pulling out. They were,
Allstate and State Farm. Nice try though.
State Farm, sorry. I get them all mixed up always.
Yeah.
But they were some of the cheaper ones. So now we're running into where it's going to be more expensive as these insurance companies are pulling out. But again, tell your clients it's really critical to keep those payments current and set up an auto pay. That's the only solution.
Well, but auto pay does not, that you have to double check your own work. That's all I got to say. Remember, we have CPI numbers coming next week, June 13th. That'll be very exciting and very interesting to see, because we've had some pretty strong job numbers on the surface. We had the unemployment rate though. I love it when they're like, yeah, we have 339,000 job creations. And the estimate was for 190,000, with 93,000 upwards in revisions for the previous few months. But then the unemployment rate went from 3.4 to 3.7. So explain. No? Oh, yeah. That's because there's a birth debt rate that's partly built into this, where they're modeling these job creations. So I'm like, okay, maybe we had 339,000
They're still
jobs.
making up the numbers, you're saying.
I feel like the books are being cooked 100%.
Yeah, there's a million different influences of, if you're looking at it in a, this little tiny space,
Well, you've got the household survey, and that's the unemployment rate. And so they call like 60,000 people to ask them their opinions. All right. So
I never got the call.
if we call 60,000 people and ask for their opinions, I can only imagine what the answers are going to be. And then we've got the establishment survey, which is a lot of modeling. So it's the modeling that I'm taking issue with. I'm like, I just don't know how effective it is these days, but
here's the other thing. Who's answering their phone to do a survey? You also have to think of the type of the person who is going to accept that call, and not only accept that call, agree to do a survey after.
And 60,000, I can't believe there's 60,000 people that would actually do that.
No.
You know what I think it is? I think it's that meter maid that was a girlfriend of Sky I work with, and she confessed to him that she used to sit in the park on sunny days and make up license plate numbers and just write a bunch of tickets.
Wait, what? Oh my God, do not tell me crap like that. Drives me nuts. Okay, so I would I'd just like to say, oh my God, somebody wrote something nice. I love that. That's so sweet. Hang on, need a moment. Okay, so just in
let's bring back the meter maid or bad stories to make.
I hate meter maids. Yeah, I just need it was like to have me put some aloe put on the meter maid story. So the Saudis cut oil production. So we're a little worried about that impacting our inflation numbers, because we had oil at the $74 a barrel, and now who knows what it's going to be. Do you know what it is today, Kevin?
No, I don't offhand, but I do know that the last time the Saudis tried this little stunt back at the beginning of the year, it actually had no effect on oil prices. The market just absorbed.
Well, they are building a new city in the middle of the desert.
I know, and they need the
for
money.
So I forget what it's called, but there you go. Yeah. What else you got, Kevin? Anything?
No, we definitely need to do a show on credit scoring sometime of what.
How are we going to do that? We have gotten all the information that we can. What are we going to do? What else should we know, Tracy?
Like things like, Alan was asking if a medical collection comes off, how does that affect the credit score? And I've heard like rumors that if you leave, $10 on your credit card balance instead of paying it off, that improves your credit scores. I would love to see a show on that. That'd be kind of fun.
Fun? Tracy, do you think that'd be fun?
Listen, I just think that this credit discussion, it's always fun. Super
It always
sexy.
is fun.
Yeah, listen, so you're asking the wrong person of who thinks it's fun, but I'd be happy to do that or ever answer anybody's questions. And if we didn't get to them today, feel free to email me and I'd be happy to answer them for
What's
you.
your email address, Tracey King
It
at
is-
Partners Credit?
It's tking@partnerscredit.com. And I think it was on your invite this week at the bottom too. So you can always feel free to email me and I'll respond accordingly.
I will say that when Tracy and I get together for our rare but amazing dinners, all we talk about is credit. Never another single topic.
I could imagine.
ever.
Not another ducking thing.
Exactly. And just for you guys this week, what I want you to do is I want you to go back through your list of people who you have worked with, talked to in the past year who said no. I want you to call them and talk to them about the market and the appreciation that is happening again. And the fact that now is the best time they're going to have to buy a house. Go get some new loans, people. Go get some new loans. And guess who we have next week? Kevin, do you remember?
No, I don't at all. But I think she works for the government.
Oh, so he remembers something. It's one of our favorite guests, Julian Joseph with FHA. She just got a promotion a few months ago, yet she is still excited to come and share with us what's happening in her world. And so we're really looking forward to that. And Tracey King, we think that you are just the best. We love you so much. And if you have any questions or need credit or just need to talk to somebody about credit services, for God's sake, call Tracey King. She's really wonderful. So with that, we will see you next Tuesday, 11 a.m. Pacific time, 3 p.m. Eastern time, or wherever you are in between or on the outskirts of Hawaii. Anyway, have a great week, guys.
Bye. Thank you.
Bye.